Good day, everyone. Today is August the 5th, 2024. It is 6:21 a.m. Eastern Standard Time as I record this. We have a series on YouTube that's sort of called Quick Charts, where I just post a quick chart and sort of what I'm thinking about it. And it's meant to be 5 to 6 minute videos. I haven't done a lot in there lately. I was thinking about putting this entry into that series, but it may not fit. Events have been rapidly unfolding since Friday. And I thought, no, I don't think it's going to sort of be a quick charts entry. I just want something, and I have done these sort of projects before, like GTC Traders as a brand, and I thought we need maybe some sort of new category. I don't even know what we're going to name it right now, where we're just talking about what we see ongoing, and especially is that true right now as markets unravel. So how do we put this? What is that line from The Princess Bride? Let me explain. No, there's too much. Let me sum up. So the current debate has been the Fed needs to cut the rate. 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 Now, others like myself, it's like, I don't see it, folks. I don't see why the Fed needs to cut the rate. Rates can normalize at a higher interest rate, and the economy can sort of normalize there. I don't see it. And especially when you look across, broad econometric data, I just don't see it. And as a matter of fact, if they're not going to tighten even more, which I wouldn't mind, it's like if they're not going to tighten even more, then, at least don't make the mistake of cutting. And on Friday, we had NFP released, right? And you saw unemployment tick up a little bit. And here's what I sort of want to focus in on. Because I've talked with many, many people over the last, whatever it's been, 72 hours. And I see a lot of the retail traders I speak with making spurious correlations. And you know how you can tell when somebody's making a spurious correlation or saying this is caused by that. And it's, because look, this happened and then that happened. And the two things have absolutely nothing to do with each other, right? There's actually a website out there, if you can find it, regarding spurious correlations, and it's beautiful. I always point ones towards it. I love it. Like the number of people who have died by suffocating in their bed sheets and, obesity due to whatever are tightly correlated, right? Two things that have nothing to do with each other. There's no correlation does not prove causation, right? That whole thing. Just because two things are moving similarly does not mean they're related. And so I see a lot of retail traders making that mistake. And there's always a couple of markers I can tell when people are making that mistake. A, I'm right. I know I'm right. Anybody that tells me that, anyone that looks at me and says, I know I'm right, okay, I know you're probably wrong. The most qualified, the most spectacular traders I have ever met in my life never say things like that. And it's only reinforced by fictional, like the fictional Bobby Axelrod, I am not uncertain. That whole thing, that people think that that's what trading's about. And trading's about being malleable and keeping your mind open. I use quantitative models. I use gray box models. I use discretionary models. I don't believe in any of them. My best performing ones, I don't believe in at all. Right? You almost have to be a critic and a cynic about everything while remaining open to all. To be a trader, you have to be very, very malleable. And I kept on seeing that, right? Oh, no, it's about this. Oh, no, it's about X, Y, Z. And I know I'm right, right? And so on Friday, unemployment ticked up by a little bit. And it's like, aha, see, there they need to cut. And again, I don't see it. I don't see it at all. Like, unemployment right now, if we can look at unemployment at the moment. This right here is 3-month SOFR futures. Tier 1 and Tier 2 members know I've been looking at that quite heavily. 90-day SOFR futures. This one is the first red. So if you don't know anything about short-term interest rate derivatives, well, it's probably a plus in your hat because we're a sick little bunch. First four contracts in the terms are called the white pack. This one's called the first red, right? So I'm not going to get into short-term interest rates here, but there's white pack, red pack, green pack, blue pack, gold pack, and they go on and on and on down the terms. I've been watching the first red or the September 2025 term of short-term interest rates quite heavily. And I have been for a while as a tell. Tier 1 and Tier 2 members know that, right? And we have just leapt higher. Like, if I could say one thing right now, what I think, and I'm saying here saying like, oh, I know this is exactly, but what I think has happened, and I've said this since Fridays, I think Japan's wrecking out. Excuse me. And on the topic of Japan wrecking out, I would offer that markets, for you folks that are new, or perhaps you do not do this on a daily basis, aspiring traders, newer traders, traders that do not do this on a daily basis and think it's just about buy low and sell high and buy low, markets are far, far, far more involved than you know. It never ceases to amaze me. Just, I'll talk about a particular trade or not even a trade that I have on, but let's just say, you'll see in the social media streams that XYZ firm has, ABC position. Everybody starts to criticize it. And I've always found that so funny because there is no possible way you know what their position is, right? We will have a position in a particular asset, and it's not a one-piece position. It's like a four-piece position. We just recently were peeling and ducking and weaving from different positions and relationship trades. Listen, okay, yes, there's outright trading. That's what most new guys know of, right? Buy low, sell high, buy low. And that's all they know of. There's also spreading. There's pairs trades. There's delta neutral trades. These are all wildly different categories of how you make the money. So yes, buy low, sell high, that's outright trading. Then there's spreading. You are buying AX and selling AX2. And there's a number of ways to do that, and your difference is the spread is your profit. There's delta neutral trading, where you try to keep your deltas neutral as you make bets on either side. And the passage of time and the quelling of volatility, there's your profit. There's arbitrage trades, which is like spreading and complex spreading, because complex spreading is a whole different thing. Gone to university, because usually there's a third piece that you're trying to capture besides the difference in, just when you just look at pure basis. And you're looking at the difference in the spread, and you're trying to capture the profit of the difference in the spread. Then there's usually like a third or a fourth piece that you're trying to capture, and that would be more arbitrage trading. There's carry trades. Carry neutral. These are all wildly different categories, and it's like I'll talk to retail trader. It's like, well, all you got to do is buy low and sell high and buy low, and they have a position in XYZ. Ha ha ha! Aren't they so stupid? And it's like, you have no idea if that's not part of a 5-piece pair trade. Like, you don't know, or some sort of relationship trade. Nobody knows what's going on in somebody else's book. And as far as retail traders, markets are far more involved than you know. Far more involved than you realize. And trading approaches are far more involved than you realize. So, like I said before, I think Japan is wrecking out. What you see right now is not about the U.S. economy. One's looked at NFP on Friday and is like, haha, see, we were right. We were right, and they should have been cutting the rate, making it easier for everybody. And it's like, well, the Fed's job is the United States economy, and that's what they got to be concerned about with the dual mandate. Where's the pressure at, and what do they need to focus in on? And I just don't see it in the U.S. economy. Oh, no, look at the unemployment rate. All right, let's do that, shall we? Here we go. Here's the historic unemployment rate. See this right here? This is us, historic lows. Yes, it's ticked up a little bit, but just a little bit. We are at historic lows at the moment for the unemployment rate. So I still don't see we have to drastically cut the interest rate by 50 basis points. Because of what? GDP right now, we are above 2017 and 2018 levels. I don't see it, right? And ones are like, haha, well, you're late to the party. Here's what I think. What's happening right now is a carry trade unwind. We don't know how pervasive it is, so we don't know how big it is, but this is all about Japan. Japan has done messed up. Japan, you done messed up. And what you see going on in worldwide markets right now, we believe, because you have to have some belief and go with it, but be malleable. What you see going on right now is about Japan. And quite frankly, Japan's doing much of the Fed's heavy lifting for them. Heavy lifting for them. If you wanted cheaper interest rates, well, Japan's sort of providing that. But we said it in our Twitter stream on Friday, you can forget NFP and the economy weakening, et cetera. Because everybody was still debating back then, oh, we think this is about, the economy is weakening and the Fed's behind the curve again. And we said on Friday, this is about Japan. So we've been there since NFP was released. And for anyone that thinks this is a normal correction, you're wrong. So, I mean, you don't have to just look at SOFR futures, or the first red. Good Lord, what is the second red's up 9 ticks right now? First red's up 10.5 ticks. Last white's up 11.5 ticks. So you don't even have to look at 90-day interest rates. It's all becoming systematic as many correlations in risk assets move to 1. This is something I've said for like decades. You're all properly diversified until all correlations on all assets, on all risk assets, move towards 1, because that's what they do in risk-off events. And I'm sitting here trying to think of a setup where I can sort of show this visually. Here we go. Here's one way to show it. These are standard deviations on a linear sort of setup with the data that we have on hand for a particular periodicity. So I just need to describe what you're looking at, right? So the middle line is obviously the mean. On each side, you have 1 standard deviation, and then you have 2 standard deviations, right? This, I think what I had up was the Russell at the moment. So it just shows you how large is the move for those folks who are new. Most moves, most of the time, I'm generalizing here greatly, okay? But for folks who are new, stay within a 1 standard to 2 standard deviation range. So that's why I have 1 to 2 standard deviations. Now that happens quite often in risk-off events that you go far beyond a 1 standard or a 2 standard deviation range. But most of the time when markets are sort of ho-hum, that's sort of where you're at. All right, so you look at the dollar yen, because I think this is all about a carry trade unwind, and the problem is we don't know how pervasive that carry trade is. But if you want to look at the currency pair of the ninja or the dollar yen, for newer folks, we've moved to what, 1, 2, that's got to be past 3 standard deviations now. Everything is breaking out from Japan because of carry trade unwinds, is what's being said by many at this point, and I can totally see that argument. So if you're not familiar with carry trades, the whole concept of a carry trade is, and I'm trying to make this simple because it can get into like 4 different currencies, and where's your parity, and where's, what's your beneficial rate. I don't want to get into all of that because I do realize a lot of folks, and who we try to appeal to, are people who are new retail traders. What we provide is sort of taking a sort of a qualitative and quantitative conceptual look at things to improve your trading and sort of provide mentorship that way. But we don't advise, we just let ones look over our shoulder with what we're thinking. So to make carry trade simple, right? You know what you can sort of visualize it as? And let me back this up a little bit. You can sort of visualize it as like, how those dividend guys, the professional term is more fixed income investing, but the guys that get involved in that dividend, they call it dividend investing, even though it's actually fixed income investing. And they get on this dividend crack, like, oh, more dividends, and it's just yield crack. Well, imagine that times 10, and you've got a carry trade. So let's say you buy dollars, which there's a very beneficial interest rate there, and you sell Japanese yen. And what's the interest rate in Japan, right? You look at Japan and Europe, they took their rates negative. So you're like making out on both sides of the coin. And then the whole pair is appreciating. So it's like dividend investing that's like yield crack on crack. It's not bad per se, but ones have in the past have generally become lazy with it. And it gets to be very pervasive, and it's a very attractive trade because you can borrow in one thing, you can sell the other. There's a beneficial interest rate spread. And my God, if there's negative interest rates, like, think about that. You've got a beneficial interest rate with US dollars. And you could be, if the rate was still negative, you could be still getting paid on the other interest rate by selling like something like yen. Listen, you can say what you want about the Fed, and I've disagreed with some of their moves. And other guys said this on Twitter. I retweeted it. It's fully been my entire thesis, is you can say what you want about the Fed. But you better thank the God you worship that the Fed never took interest rates negative. Because Japan, somebody else said this in Twitter, I know I retweeted it, but because Japan and Europe are going to be paying for that mistake for a long, long time, which is ironic because if anything was proven during that time period, low inflation had nothing to do with the interest rates and had more to do with the ease of the global supply chain and the multiplicity of products. That's just facts. So, and that's been proven out now. But Japan and Europe did take interest rates negative. So the distance they have to cover to close that spread is tremendous. We don't know how pervasive this trade became because you could do things like return stacking, right? As you gained more and more in terms of benefit of a carry trade, then you just start stacking that into other things, right? So what we think you're seeing is an unwind of that because Japan messed up. Japan, when it comes to their rate, they have done fouled up. And when it was really appreciating, they did not draw a line in the sand definitively, as the Swiss did back in 2015, and keep to their word. And mind you, the Swissy move of 2015 on the Swiss franc was exceptionally disruptive. Probably the move of the year for 2015. However, the Swiss did what they said. They said they were going to do it, and they did it, right? And Japan has not been that definitive. And now we got a carry trade unwind. Dollar yen is at, it's got to be over 3 standard deviations. This is not your usual correction. And the point we just wanted to make, and we made it on Friday with NFP, if you're pointing at the U.S. economy, you're looking at the wrong thing. We think. We're not going to say, definitively, but we thought on Friday, you're looking in the wrong direction. Because this fastball is coming out of Japan. You look at their equity markets, they were down something like 4 standard deviations. 5, 1, 2. Yeah, they were down 4 standard deviations. You look at the 2-year as everything unwinds. Look at the 2-year. The 2 years at 4 standard deviations. And the thing to keep in mind is this bleeds out into everything. This is oil. Oil's past this 2 standard deviation move because as they, in carry trade situations and when they unwind, because people get lazy with carry trades, is they've so stacked into everything and sort of pyramided based off that beneficial interest rate that they've got a multiplicity of assets now that they've got to unwind and sell and get rid of. So that's what we're seeing, we think. But in conclusion, I'd say be very careful of spurious correlations. Null hypothesis or H-Naught, right? On a spurious correlation. So what do we mean when we say that? I buy stocks on Tuesday when I look out the window and I see a red robin, right? And look at that, stocks went up. So that proves that robin has a great predictive power. No, the two things have nothing to do with one another. There's no causation there whatsoever. That's a spurious correlation. So you got to be careful of making spurious correlations. You got to be very careful of saying, I know I'm right. I know I'm right. Really? Like that's not how every professional trader that I've ever learned from and has mentored me over the many decades that I've been doing this. I've been doing this now almost 30 years. I've never heard them say things like that. I think could be we're looking at this. This is how we're positioned. We'll be willing to adjust. That's how I hear them talk. And that's how I've always heard them talk. So that's how I've tried to make sure my speech is like that. At the moment, we're fine. We had a put we had to remove on oil, and that caused a small loss for us. Tier 1 and Tier 2 members already know this, but at the moment we have a bias bet on. We had made a bias bet on the Russell falling. That seems to be working out very well, and we had nothing on the other side, so it's like, no, we're just making a bias bet the Russell's going to fall. So that seems to be working out very well. We also had a bias bet, and it was for a different reason. It started off a different way, but it has sort of morphed into this in the last 2 weeks. So we had a bias bet short the Russell. We had a bias bet short the S&P 500 index. We have an outright short by using an inverse against the S&P 500 index. Remember, those are bias bets, so that's a little differently. And these just sort of, it seems very correlated, right? It's like, why are you making so many correlated bets? And it's because it didn't start out that way. But as all correlations on risk assets move to 1 and you make adjustments, that's sort of where you end up, at least if you've run in your portfolio well. So those were bias bets. We have an outright short using an inverse on the S&P. That's working out very well. We are holding treasury bills. That's working out quite well. And at the moment, we have a net long in bonds. Now, that one has sort of moved to a covered call where we've sort of maxed out, and we want to see what we can do there. We don't know where we're going to end up with it, but it's very obviously we're net long bonds, right? So we had an arbitrage on with this particular thing. We removed part of the pieces for the arbitrage trade, and we're just left being net long and have been left net long for a while now in bonds. So, we're doing well. We printed black last month, and looks like we could print black this month. Of course, it's too early to tell in August. But at least that's how we're positioned. And it's what we think. Because we're not going to sit here and say, no, it is because of this reason, and you just watch and I will be right. That's predictive, and it doesn't work. And I'm not saying that out of opinion. I'm saying that that's been proven scientifically in every field, everywhere. If you want to model for everything, predictions do not work. You will get some guesses right, and that's all they are, and it's probability and statistics. If you want to look at the world of trading and markets well, learn Bayesian probability statistics, learn statistics, learn probabilities, because that's the way you have to react. That's the way you have to approach markets if you want to stay in the black. We're in the black at the moment, and that's where we want to stay. So that's what we think's going on. We think Japan's wrecking out. Well, when's it going to stop? When it stops. Like, nobody here can tell you, I can't tell you how pervasive the carry trade has become. I can't tell you how this is going to move out, and because nobody knows. Nobody knows. Anybody tells you they know is a liar, a fool, or both. Nobody knows how systemic this problem has become. And it has nothing to do with the U.S. economy at all, or at least in our belief. Japan is wrecking out, and I think that's pretty obvious for anybody to see. At a certain point, something becomes pretty well known. Now, how systemic is that? We don't know yet. We're waiting for something to show us there is a true break on the periodicity of what we're looking at, the appropriate periodicities. And on our long-term core hedge stuff, we're more than pleased. The yield on cost is increasing for fixed income. I think income per month on that, and that's brand new on the fixed income core stuff. We went light. We've been hedged since last week on all of those longer-term core pieces. You'll say, well, it's only 20% of the value of what you hold. Well, you have to look at your beta weighted deltas as well. Don't forget that. So we're hedged on our fixed income stuff, right? That's paying $17.21 a month. So that pays more than the cost of tier 1. And that's only going to improve, right? The income per month is only going to improve. So we're hedged up on that side. So, as the market sinks, our hedge for the fixed income portfolio is also gaining. So we're okay with where we're at. But, it might be a long week. We don't know yet. We just have to wait and see how the market unfolds and either ride it or make the adjustments when they're necessary. Okay? So that has been our thoughts. That's just been what we're thinking at the moment. I don't know how we'll categorize this, but it has been what it's always been. It's simply been our thoughts, not yours. For whatever the heck day it is, as always, stay safe, trade well, and remember that love doesn't cost a dime.